So, now when fund managers come into our office and they spend the first 15 minutes on the corporate overview, we tend to try and move them along. But if you'll just sort of forgive me for a couple of minutes, because this is a name that a lot of people probably wouldn't have come across. And, some people in the room might know me from InvestSense. And we've got a few logos going on down here, powered by BetaShares and InvestSense. And the background to that is Australia Wealth Partner was formed from the combination of BetaShares managed accounts, mainly DAA, and the InvestSense offering. And that was about 9 months ago, I think. There's a lot of logos and a lot of positioning, and it's caused a lot of strife for our sort of marketing department. But it's kind of coming together. We're still InvestSense. The products that we manage are still InvestSense. You can still view us as that, but we've also got this passive element. And there's a whole lot of other things that are happening, which we kind of were comfortable with, hence the branding. Trelia sort of recalls Trellis, so building a framework for advisor practices to grow. And there's a lot of sort of exciting things happening. We had our first inaugural client conference earlier this week in the Yarra Valley, and I got the sense that that's in front of our clients. That message is getting out there, and externally in the next few months there's a lot more coming out. But it's basically supporting advisors, and our offering is broadening. But this is kind of an InvestSense story to some extent, multi-asset, active. We use kind of half our portfolios tend to be sort of passive, and the rest, we still use active managers. So this story is really, and it's just to prove my independence, really. It's a big fat excuse for active management, just to prove that we haven't changed our stripes. But it sort of harks back to a little bit, and Toby, well done. You hadn't even seen the presentation until last night, but somehow it syncs very well with the first two presentations, and especially the first one, with this notion of uncertainty. No one really knows. And I particularly loved that comment at the end, and I'm going to borrow it, Kerry, that you hedge your risks and you diversify against the things that you don't know about. Because we think there's a few opportunities out there, and I'm going to highlight one in particular, which are not obvious. And just the way we go about things, and the current sort of situation from a valuation point of view gives you a lot of optionality, and you don't have to know what is happening next. And it's about this sort of sense, that's the uncertainty. Are we in the middle of a regime change or not? It's been sort of 15 years of things sort of going one way. It's difficult to sort of time change. And you do need that structural diversification. And there's a lot of polarized markets, a lot of seemingly things on the same side of the boat, a lot of I haven't got it here. I've got quite a few charts, but not this one, which shows if you do the look through on everything that you have in portfolios, what are the sort of major themes that come through, and AI is the biggest by far. That's probably encapsulated in the Mag 7. So first of all, basically the presentation split into two parts. There's a fairly boring part, which is techie and kind of about our process. If you make it through the first 10 minutes, I think it gets a little bit more interesting. Please do ask questions, because as I said, listening to me for that long uninterrupted is a challenge. So what this chart is a forward-looking risk-return chart. And on the vertical axis, we've got long-term expected returns, risk premiums, and on the horizontal axis, we've got we call it a potential loss estimate. It's a sort of, 2 standard deviations. What happens 1 in 20 years, although it's financial markets, so it happens more often than that. And if this line is flat, you're not getting a lot of bang for buck. And if it's really steep, like January 2009, no one wants to invest, and that's exactly why you are getting a lot more bang for buck. So it does move around, and where we've landed is it's kind of a little bit flat. This is kind of the proof statement. So if you take a dumb version of that, and the risk premium is, golden growth model for the techies out there with a bit of mean reversion. So what are the cash flows? How much are they growing by? And, what happens if, historical normacy sort of asserts itself? if things change. And the green line is what you would expect with just that simple framework rolled back over 120 years, and the black line is what actually happened rolled forward 10 years. And you can see there's a reasonable correlation. This is basically saying don't just do SAA, or if you're talking to me about beta shares, DAA, do. But anyway, that's another story. That was a kind of in joke, but it's risk premiums matter, and that's a little bit about what we do at InvestSense. Is we kind of try and adjust. Obviously subject to the constraints of your future, your super, try and adjust to the ebb and flow of that. But as you can see here, the rubber band is getting stretched to some degree. And it's been quite a while that the US equities have surpassed those expectations that you would have had potentially on a 10-year basis. And this is just kind of interesting to look at it at an asset class level. So that's the same thing over 20 years. And if we compare that with emerging markets, you can see there's been times, and this is the counter-cyclicality. And even over the last, only 20 or 30 years, you can see that there's a pattern that emerges here. I think I've got a little pointer. So you can see coming out of .com, there was, think of this as being the era when, Microsoft and Apple and, their names were dirt. Those so-called sort of quality companies, as they came to be known afterwards, were sort of trading on multiples of high single digits, low double digits, throwing out cash, starting to grow quite significantly, but no one wanted a bar of it because we just had .com. Meanwhile, it was all about China. So since 2000, China was sort of starting to take over, and you can see here. As a function of that, if you tried to look through the cycle, expected returns were really very low. So when the GFC hit, they got hit by even more, and obviously, American equities also suffered, but the expected returns really became quite huge. And since then, it's been a one-way trip all the way down there. Emerging markets have had a little bit more of a sort of rocky road. So around here, things dipped down a little bit. China hit the $1.5 trillion stimulus button, and it was all about the emerging market consumer. You could buy products for that. There's not many of those around at the moment, is there? Then you got to roll forward. That was sort of over discounted, if you like. Expected returns have gone up, and they've sort of been range bound since then. And we had COVID. And if you think about it, especially if the great hope was that we were going to emerging markets were going to become consumption driven, COVID was exactly the wrong thing to happen for that to eventuate. Because Western consumers got bailed out, emerging market consumers didn't. It was a really sad place being an emerging market consumer over the last 5 years or around COVID and following. So emerging markets was just getting battered, and then obviously Liberation Day wasn't immediately seen as much of a positive. And then just sort of by the by, I've just added a few others. And this is kind of to demonstrate a couple of things. One, that there are a few other things. I'm going to zoom in on emerging markets here, but global small caps. The UK, which is an interesting one. Now, there's two things that we say in a positive sense, this kind of way of looking at the world. There's a few sort of narratives that we use. One is that the short term, as you saw in that first chart, the long term often happens in the short term. Risk premiums get compressed, and then something changes, and then you see the risk. And that's kind of like a bug waiting for a windscreen. You don't know when it's going to happen, but there's, something happens. The more positive side of that is putting yourself in the way of good luck. And I think the UK was a good example of that. Very difficult to predict that the UK was actually going to be up in 2022 when the rest of the world was down. But you did know that risk premiums were compressed. Something happened. You didn't know what it was going to do. And most markets fell from that. The UK, at that point, already had very high risk premiums built in, so it was already more resilient. And it just so happened that luck came its way in that having a lot of resources in there and or financial services as well. Actually, investors rotated into that, and you ended up with a positive return. So this is another way that we look at it, sort of within asset classes. And you can see if we go back, about 15 months. The sort of main thing, it's the what we try and zoom on in when we look to the long term and wonder whether something might happen into the short term. And this is our way of diversifying when we don't know what's going to happen next. You just put yourself in the way of things that seem fairly valued. And then, this, as I said before, if this is a very shallow line, well, danger Will Robinson everywhere. You're probably going to see risk premiums move up. If it's a very steep line, well, everyone's probably fairly cautious at the time. And it kind of doesn't matter where you go. This is kind of interesting because it shouldn't really happen. And you'll notice that actually the US equity line is not nearly as low. This is, obviously, I wasn't alive 120 years ago, and I wasn't, all that productive even 30 years ago. So that's a kind of naive framework pushback. Whereas when we actually do this day to day and we sort of adjust these things every quarter, or if markets move by 10%, and that US line there wasn't sort of down here, it was actually up here. So we are allowing for the fact that corporate profits in the UK are very high, expected to continue. Return on equity is elevated, and people will pay $1 more for those earnings than they would other countries. So even after you adjust for that, it's sort of at the lower end, and because of that, you end up with a bit more risk. And that was probably as we saw it, the arbitrage. And you did have the rotation trade last year. So again, the long term happening in the short term to some extent. And here things have bunched up a little bit. But the thing I would say here is that, and it talks to polarized markets, it's no longer enough to think about these little dots in isolation. If you break that open, that little blue one there, that's US equities. Well, actually, it's two risk premiums, isn't it? Call it Mag 7, that's a bit lazy. Mag 7, it was plus software, that's changing. But there's, call it AI now, plus everything else. And that's very different. And as I'll delve into in a minute, they have had very different experiences. If you look at Australia, it's banks. That's a risk premium that you make money 9 years out of 10, or for in Australia's case, 24 or 25, and then you give a lot of it back in the last one. So it's got a very different sort of risk premium, a different profile, and then you've got materials, which has got a sort of wider band and sort of difficult to pin down, and then you've got the rest. And I think we've seen that in the local market. That's kind of how it is polarized. Those risk premiums are very kind of different. And that brings us to emerging markets, where we've seen something similar as well, where you've got Taiwan and Korea, which are arguably not that emerging, and you've got the rest. And those first ones are very much related to, or have been recently, to what's going on in Western markets. So with that context, we're presented with a track record like this. Looks pretty sorry. Lots of FOMO going on there. The manager's underperformed by a fair whack. And this is the sort of case study element of this. We looked at that, and we kind of knew the strategy. Maybe we had half an idea of what we'd seen, but we are kind of running out of patience a little bit here. And we think, in line with what I was saying before, with polarized markets, you've really got to turn over every stone and start looking within portfolios. It's all about the look through, we think. So then when you construct another index, which we did, showing, if you take out Korea and Taiwan, and bearing in mind that this strategy for the 15 or so years it's been running has always said we're not going to invest in Korea and Taiwan because it's emerging market consumer growth, and that's not that. So actually, to be fair, maybe that was our allocation mistake, but if we want to judge the manager fairly, they've actually done all right. And this, underscores we're seeing a similar story in Australia, in the US, where there is this polarization, not just of markets and sentiment, but actually underlying earnings as well. So, on the other hand, though, is this something that we can really ignore, the rest of emerging markets? And I won't labour this because I think everyone in the room has probably seen something like this. If you're MSCI World Benchmark, a lot of passive products out there that they've got no emerging markets. All countries, you've got about sort of 12%. But the underlying GDP of the world, in nominal terms, is 40% emerging markets. If you adjust that for purchasing power parity, it's half of the world. But even more important, if you're looking for growth in portfolios, where we're dominated by economies subject to aging demographics, where 1.5% to 2% is starting to look like an okay result, and that's what people are sort of looking for. Meanwhile, places like China disappointed with 5%, higher growth rates in places like India, South America. You've kind of got to think, well, if I want growth in my portfolios and I want to meet those CPI objectives, I'm probably going to need something else. Because, Mag 7 earnings over the last few years notwithstanding, GDP growth eventually leads to corporate profit growth. And underneath the surface, you can see, even though emerging markets, and especially some portfolios, have gone nowhere for 5 years, gradually, that as a proportion, they're getting bigger. And when you think about where, as a proportion of the growth, it's actually more like 70% at the moment, and that seems to be growing. So maybe it's something that you've got to sort of think about if you want to have, if you want to reach the CPI objectives that we're, talking to clients about. So this is where the sort of case study comes in, where it sort of got really interesting. And we don't, necessarily always give managers such an easy ride. This is a pretty positive story. So any fundies here, if you've got any sort of brown paper bags, you can get sort of similar treatment. Just kidding. Sorry, I'll just go back one just before I do that. So this is 3-year historical earnings. And this kind of, for a start, this is interesting. S&P 500 over the last 3 years have grown earnings by under 5%. By the time you get to the Nasdaq, it's 10%. So you think about, you strip out the sort of Nasdaq stocks, the Mag 7 from the S&P 500, it points to that sort of K-shaped, polarized, not only markets and economies, but also profitability picture. And MSCI World, kind of roughly similar, which is kind of interesting. So there's obviously things going on in the rest of the world that are not that bad either. If you look at emerging markets, well, it has been a sort of rough period, roughly the same, but it's kind of the same as the S&P 500. And then you've got this fund manager. We look back and we kind of started to push on this because they were sort of giving us some quite bullish messages. So we said, kind of show us the money. What have the earnings been over the last 3 years? And this is the number they came up with, and then we went off and checked them on FactSec and Bloomberg, etc. And that stacks up. So what's expected going forward? Well, obviously, analysts expect an acceleration still. Maybe that's being revised down. S&P 500, it's always a little bit above what you get because analysts are optimistic. And this is the ground-up consensus 3-year forward earnings estimates per annum. And then, Nasdaq, a little bit more, but there seemed to be a bit of a broadening out. And the world, not quite as much. EM, you're seeing that uplift. And the managers' underlying estimates for these stocks, it sort of matches the market, and that seems to be sort of continuing. Now, this is where this gets to the diversify margin of safety sort of aspect. Is kind of interesting to look at what the annualized volatility. Just take the last year, but it's been like this for a few years. Here we live in a world. So this is Nasdaq, and you could actually just maybe coincidentally, if you think about Liberation Day, Nasdaq was down by about that, 16%. Emerging markets down by less than that, and this strategy actually hardly moved at all. It was actually probably net sort of positive over the period. So you're seeing a similar relationship, whether it's volatility or drawdown. Something's going on there. We live in a world where the market, it's not a world where the US catches the cold and emerging markets get pneumonia. There's something else going on. They are less volatile. They seem to be more of a backwater than a lightning rod for risk. And that's kind of telling you, I think, that there's a kind of, it's a margin of safety argument, but it's also a growth margin of safety argument. The market's obviously more confident about that 25% growth coming from emerging markets and the resilience of it compared to the binary outcomes of the concentrated growth that we'll see arguably from places like the US and the AM infrastructure build-out. Another way of looking at that is Microsoft could be very cheap. If, as consensus estimates are, say it grows by 15% per annum for the next 5 and even longer years, and earnings never fade, it's actually pretty cheap. It's a good buy, especially now. If, on the other hand, something changes, it could turn out to be very expensive. It's just a very wide outcome, or a very wide range of possibilities. So when we sort of chart that, the question then is, well, look. if no one wants to buy it, there's governance risk. No one's going to buy, Alibaba and Tencent again in this environment. Although I thought some of Kerry's points were again quite, it is a multipolar world. And you are seeing trade and that trade agreement between Australia and Europe. Things are happening around the rest of the world, so maybe it's not as simple as we'll never buy Chinese equities again. So if we wanted to sort of calibrate that, what you want here is, so this is forward PE. Obviously, you want to be down here. That's better than not, but you tend to get less earnings, and so you get this kind of a relationship. And obviously you've got a bit of variability there, but you've got higher growth and you're paying a higher multiple for it. Emerging markets, just the index, kind of takes you into this kind of positive zone. Like, that's a big difference. You're paying a lower multiple for higher expected growth. And that's where that manager sits, and it's slightly higher multiple. But the interesting thing about this is, if all those domestic consumption, which, let's face it, domestic consumption, there's not that many ETFs doing that anymore. It's a little bit out of favour. But in the background, it seems to be kind of happening. But if that never happens, then you've just got something that's not that cheap, maybe growing, but the world's got to sort of recognise it. Well, my kind of response to that is, if that happens, like 25% growth compounded, it actually gets quite reasonable, and you start getting cash getting thrown off, and people take notice. And again, if things change, another kind of dynamic to that potentially you could throw in there is that if it's like 2000 when we had the dot-com crash. We were in the middle between 2001 and 2004. It was a slow grinding recession. US industrial small caps were up by 30%, and there was a few other things like that. So obviously there was that rotational effect as well. So that's what you kind of want to happen. But even if it doesn't, those earnings compound. And after year two, your PE ratio is coming down, and then by 3 years from now, and I think this is the mentality we have to have investors, especially in multi-asset portfolios, where we can afford to take a view. Actually, you end up with something which is a value investment with a growth profile. It just kind of gets better as long as the earnings are coming through. So this is obviously Nirvana, and this is Nvidia. It's another one. Potentially now it could be quite cheap if consensus earnings estimates and Nvidia's forecasts actually come about. Then trading on sort of mid-20s, it could potentially be quite cheap. The other thing about Nvidia is it's throwing off cash, and that cash isn't they can't spend it quick enough. So that's building up on the balance sheet. So that's basically the positive sort of narrative. And I showed you that one there because it's about to be a sort of blizzard of charts, where if we look at the sort of top 9 companies in the NASDAQ, we see, so obviously Apple, it's always expected that the earnings are going to explode. It never really does, and so it gets more expensive. But possibly that'll happen. But generally you can see there, if you compare the lines here, it's sort of cash from operations, free cash flow. So it's like you think about an Amazon, there is a scenario where, you make lots of money, but you spend it on stuff which ultimately ends up being not as productive as you thought, which is, not necessarily positive. But, you kind of want to see all of these things going up. And it is a pretty positive story. You've got ASML here, Broadcom, Alphabet, Google, Tesla even, Amazon, Apple, Meta, Microsoft, and Nvidia. And then sort of compare it with what we're going on here. Now this is, again, you can't really, I'll just read them out. Tencent, Alibaba, Mercado Libre, Cattle, Hotel World, Gentera, I can't pronounce that, Parquet, Co, Apollo Hospitals, and Alsea. And first of all, there's the visual image that actually there's a lot of cash being generated. It's not all being spent. It's building up. And these growth rates, the growth rate for this is about 22% on average. The one before was about 21%. So it's very comparable. But the big difference is that previous chart, as far as the market's concerned, they're all kind of the same thing. On this chart, you've got obviously a bit of AI, but it's China-centric, doing things kind of slightly differently. So there is diversification in a global sense. Mercado Libre, South American Amazon. You've got microfinance in Mexico. You've got hotels, and some of this stuff is really cool. These robot hotels. If you go and stay in one of those, it does kind of confront you with the image that the Chinese are just copying our tech. There's lots of examples of that, but these hotels are a good example. Really, really cheap, really, really clean, all robotic. with these little robots running around the place delivering you food and stuff like that. Quite cool. Cattle, obviously, they've kind of won the battery wars. If we are going to even, especially with higher oil prices, we're going to have more EVs. They are the supplier of choice to the Western car manufacturers and probably will continue to be so. Apollo hospitals, and there's a bit of medical tourism that they're probably getting affected by, but basically a domestic story. And in India, and you can see, and Mexican infrastructure, they're all very different. They're not one risk factor, which is maybe where you're getting the resilience from and the lack of volatility. So there you go. That's my fanboy story for emerging markets, and probably more of a case study as to why in this environment we have to sort of look underneath the bonnet, do the look through, work out what we're investing in, and sometimes, even if the government would love otherwise, maybe take a stand for things that look very prospective, and use some of your tracking error budget for situations like this. And we've made up some time.
Well done. So, John, I was at a S&P presentation masterclass yesterday, where Sue Lee from S&P was talking about SPIVA and the troubles that active managers have in outperforming the index, focused primarily on developed markets. I mean, you had manager XYZ up there, and you mentioned before that you're an active management fan.
Certainly don't tell my boss that. But no. We're completely agnostic. And
right.
if you came up with a sort of proactive management spiel, I'd probably try and argue you with that. But I will assume the debating rhetoric, if you like.
So I guess my question is, to what extent do you think active management works in emerging markets? And you put up a list of a dozen names of companies there, as opposed to the market cap weighted index approach to
So
emerging.
I think the SPIVA statistics, the ones that get quoted most often are, it's sort of like it was 10 years, then it was 12 years, now it's 15 years. And it's true, you look back 15 years, but you think about what 15 years ago, it was 2010, and you think about what's happened since then. I am relatively convinced that a lot of this is to do with the macro environment. It has been an environment where there's been excess liquidity. And actually, that's one thing I wanted to mention. Even, I agree absolutely with a lot of sales comments about cross-sectional volatility. And some of this kind of actually talks to that. And one-day options in the US and the retail bid, all of that stuff is obviously very important. But there's another thing. Since the start of and it does answer your question, sort of, in a roundabout way, the People's Bank of China has effectively, in managing their currency, injected about $280 billion into the global financial system. A lot of that's gone to the US still, but that's an interesting geopolitical argument. And the Fed and the Treasury combined have injected another $185 billion. QE is actively happening, and the Treasury General Account was being drawn out. We've had that kind of monetary management for the last 10 years. That's one of the reasons why volatility is subdued, and markets are, it makes them react differently. If you expand that little micro example out of the last 10 years, I think that is a bid against fundamental managers, because things just trade on a higher multiple, there's more money to buy this stuff, and people lean into that. Now you can see that we've done some charts which show when active management, and if you adjust for fees which have come down over time, actually it's kind of line ball. It's not that different from zero. It's sort of, by the time you account for fees. If you look at 2000, you look at global equities, Australian, around that time, the following 3 years, they outperformed. And then after the GFC, they outperformed again. So I think there's another narrative about liquidity, and also what happens, most active managers tend to have a sort of fundamental bent. And when things get expensive, they lean against that. So we had that sort of QE period. Then we had COVID. And I think that's a kind of clue that gives you a slightly more nuanced picture if you go back, say, 30 years.
So is that an argument that that a key input is monetary, is observing monetary conditions?
Yeah, absolutely.
And
just not being surprised by it, And this kind of analysis, I think, that it's areas where the rubber band has got stretched. And if as a fundamental investor who has some notion of intrinsic value, look at it and go, well, okay, that's why the manager's underperformed. What I hold is, I believe, worth this. I'm managing a multi-asset portfolio. I can keep up with the Joneses in other ways, and I have some of this in there. I think, the obsession over benchmark, fine, have the benchmarks, obsess over them. That's what we have to do. We have to manage tracking error. But I think you should look through it, and rather than just have, bland statements about all active managers being, good at some periods and bad at some periods, what are the fundamentals driving that? And I think there's a rational reason why most fund managers would have struggled more and more over the last 15 years.